Welcome back to another week. These first 4 chapters are really foundational. Spend time on them. After this, the material is more freestanding. It doesn't build on each other. These early chapters, they really build on each other, and you really need to have a grasp of the basics. Let's review for a few minutes. There's 5 types of accounts: assets, liability, owner's equity, revenue, and expense. Now this time we add a little bit of modification. Typical asset accounts are cash, accounts receivable, people who owe us money, supplies, buildings, and last week we added accumulated depreciation. Now this chapter introduces the terms current assets, and current assets are assets that are either cash or will be turned into cash or used up within 1 year. Long-term assets do not get used up within a year. So if you build a building, it lasts years and years, decades and decades. Similarly, liabilities are split into 2 accounts: current liabilities and long-term liabilities. You're a pretty smart person. You've got this figured out. A current liability is something that you're going to pay within the next 12 months. A long-term liability is you're going to pay more than 12 months later. So accounts payable and wages payable, you'll pay within the next 12 months, probably pay next month. Bonds payable, if you borrow money, you may pay it over 10 or 20 or 30 years. Owner's equity, we talked one of the initial weeks about capital is when the owners put money in. Drawing is when the owners take money out. And revenue, the book likes to use the revenue account, fees earned, and expenses could be wage expense or supply expense. Now this is how I think of these: current assets and long-term assets, current liabilities, long-term liabilities. The book likes to use current assets and plant and equipment, and that's often used, or property, plant, and equipment, instead of long-term assets. I like the long-term assets. The book likes to call it property, plant, and equipment, or property and equipment, plant and equipment, something like that. But that we're saying the same thing, and I think you ought to get used to both terms. Now, one thing we're going to do this chapter, we're going to split the accounts. Current assets, long-term assets, current liabilities, long-term liabilities, and capital are all called permanent accounts. And we're going to explain that, why they're called permanent accounts. Permanent accounts. Drawing and then our revenue and expense accounts are called temporary accounts. Temporary accounts. And so it helps to start thinking about that, and we'll see why those accounts are permanent. Assets, liabilities down through capital, and then drawing, revenue, and expense are temporary accounts. The heart of chapter 4 is all about what's called a 10-column worksheet. And accountants have trouble counting at times. There's actually 11 columns in a 10-column worksheet. There's 5 pairs of columns of 2 each. That's 10 columns. That's where they get the name. But also a list of titles off to the side. And I made a very simple example with assets, cash, and accounts receivable. The first 2 columns are the unadjusted trial balance. The word trial balance means nothing more than a list of the accounts and the dollars in each one. And I left off 3 zeros. So this is $5,000 in cash, $10,000 in accounts receivable. Those are debit balances. Assets are usually debits. The liability accounts payable is an $8,000 credit. The owner's equity, I just had one owner's equity account. Capital was $6,000. Fees earned is the revenue account, $7,000. And I have wage expense and miscellaneous expense. So the 10-column worksheet, the first step is to enter your unadjusted trial balance for the organization. And when you add down, your debits should equal your credits. They've got to equal each other. If they don't, you've done something wrong. Stop and go back and figure out what you've done wrong. Then usually you enter 4 or 5 or 6 adjustments. For every adjustment, there should be a debit and a credit. So those adjusting journal entries we talked about in chapter 3 Now, I said this builds on each other. So once we have our unadjusted trial balance in, we make the adjustments like we talked about in Chapter 3. And I'm going to do two adjustments. We paid some wages. So we're going to put $1,000 of wage expense and we're going to credit cash, reduce cash for the $1,000. The other adjustment, we owe someone $3,000 for something, so we're going to have accounts payable. We owe someone some money, $3,000, and we have miscellaneous expense. So these are two adjustments. Usually we'll have 4 or 5 or 6 adjustments, but to make it simple, we'll use just 2. We add down, debits should equal credits, 4,000 and 4,000. The next step is to take the unadjusted trial balance, add the adjustments, and get the adjusted trial balance. If it's a debit and a debit, we add the numbers together and put it as a debit. If it's a credit and a credit, we add the numbers together and put it as a credit. When it's a debit and a credit, or a credit and a debit, we subtract them and put the number where the larger number is. So 5 minus 1, and 5 is larger than 1, so we put it under the debit column. This is 10. 8 and 3, we add. Credit and credit, we add together. That becomes 11. 6 and 7, there were no adjustments. Then 5, we add debit and debit, we add 5. And debit, we add 5. 2 plus 3 and get 5. We add down 24 and 24. Debits should equal credits again, but you can't say, it'd be just a coincidence if you could say 21 plus 4 and get 25. So these won't equal the sum of these two at the bottom, but debits have got to equal credits. Each of these cases, debits have to equal credits. Now, now it gets simple. It really does. If you get this far and you're doing well and everything is good. So now we're going to take all our assets, liabilities, and owner's equity and put those on the balance sheet. So we just take these numbers and rewrite them here. Assets, liability, that's an asset. Liability is 11. We're taking the numbers from the adjusted trial balance column, and owner's equity is 6. Capital is 6. So those are the assets, liability, and owner's equity go to the right-hand columns, and the revenue and expenses go to the income statement columns. Again, it's the numbers from this middle column, so it's 7, 5, and 5. So, oops, 7 and 10. And we add these columns down, and it's 14 and 17. And now debits don't equal credits. So here's what we're going to do. Let me make that 7 better. We're going to make the columns equal each other. It looks like we have a plug number, and that's what I call it, is a plug number. How much do we have to add to 7 to get to 10? Well, obviously 3. Voila, they equal. We made them equal. How much do we have to add to 14 to get to 17? Oh, 3. So now they equal. So we put in a plug number to make them equal in these columns. What's the significance of that plug number? If you look at it, first of all, the numbers should always be the same, and one should be a debit and the other one should be a credit. So the 3 equals 3, that's good. The plug numbers are the same number. One's a credit and one's a debit. What's the significance of that number? If you think about it, 7 was the revenue, 10 were expenses, so they lost money of $3,000. So if it's a credit here, it should be a debit here, and that again, it indicates a loss of $3,000. If for some reason the numbers were here and here, the reason the number would be here, let's just change it. If this was 17 and this was 10, we'd have to add a 7. And we'd say, oh, okay, debits now equal credits because we made them equal, but this would be income. So if the number is a debit here and a credit here, that indicates income. The revenue was greater than expenses, but the way we had it initially with the number here, the expenses were greater than revenue, and so that indicated a net loss. The book does a good job with 10 column worksheets. They're complicated a little bit, but once you wrestle with them and work through them, it should be okay to understand. They're not that difficult. Good luck. See you next week.